So a very good evening to all of you. So thank you for this opportunity to talk about the budget and present our views and on how the finance minister performed yesterday. So before going into the actual budget, I just wanted to highlight the expectations, because stock market is all about expectations, right? If you meet the expectations, you're okay. If you don't meet the expectations, then you are down. If you exceed your expectations, then yes, it is going to be very positive. So it's very important that we talk about what we expected. It's not a very equivocal or unanimous decision, but this was what the majority was expecting from the budget as a whole. So, of course, like we heard the speakers before, Professor Veeramani and Priya was also mentioning about, the budget's focus on employment, important. The budget was expected to focus on infrastructure. It was also expected to focus on innovation. So these were the 3 points that the budget was expected to focus on. Plus, we were wondering on how they were going to play the balancing act. Would it give more importance to growth-oriented measures, or would it be more focused on fiscal discipline? Especially since there was not a single party absolute majority, it was a coalition government. Would there be populist measures, especially with elections also coming up in a couple of states in the coming months? Would there be more populist measures in the budget? So those were the what the wondering was all about. Second was, there was expected, there was a consumption boost that would have been given to the rural economy, because if all of you noticed, I think after the COVID, this thing, we basically have what economists called a K-shaped recovery. It was not a V, it was a K-shaped recovery, because we saw the rural economy going down while the urban economy, if you want to call it that started going up. The entry-level demand or the entry-level goods demand was coming down, while luxury goods, they were doing good. Best case example is regarding two-wheelers. For example, two-wheeler sales, it has not come back to pre-COVID levels, while four-wheelers have performed better. So a focus on rural economy was always expected in the budget. And of course, capital expenditure, the spends, it was expected, people expected more in terms of capex expenditure. So these were the expectations, I would say, if we were to look at it, maybe a pre-budget scenario, these were the main expectations, I would say. So when we look at it, after the budget, when we look at it, I think, the budget has ticked most of the boxes. But of course, there were a couple of small surprises, which would not have a huge impact on the stock market. But more or less, I think the budget would have ticked all of these expectations. Was it, a big bang budget? No, it was not. We would call it, or as Geojit Financial Services, we are neutral in terms of what impact the budget would have on the stock market. One of our analysts even called it as a boring budget. So please don't get me wrong, boring is not a bad thing, in the sense that boring has many annotations, in the sense that, it is what it is kept as it is. Continuity is a good thing. So continuity might be boring for somebody, continuity might be good for some people. So I'm not using boring in a very negative sense. It is just what it is. So sometimes we say that, okay, no news is good news, or no big bang it's good news. So there were a lot of things in the budget that the government insisted on continuing. I mean, what they were carrying from last year, I think they carried on this year. So there were a lot of things that were continuing, and it depends on our point of view also. So in our point of view, if we wanted to see big bang reforms, okay, that could be negative in the eyes of others also. So we need to look at it from the point of view as domestic investors. We need to look at it from the point of view of the foreign investors also. So in that sense, maybe continuity is a good thing in terms of the budget. So it is, so what I am about to say, maybe we might not all agree on it in a sense, but generally, if we talk about it, this was a neutral budget with no big bang reforms. But yes, the important thing was that stability, continuity, was given due importance in this budget, and that can be a good thing also. So I'll just focus on the measures because I think the speakers that were before me, I think they've given enough data about, let's say the macroeconomic impact and also the direct tax impact that was there in the last session. So the overall view on this is that fiscal consolidation, fiscal prudence was given importance, right? More than growth, I think there was a fiscal consolidation or fiscal prudence was given importance in this budget. The vision is, of course, the fiscal deficit is coming down to 4.9%. The plan is to bring it down to 4.5%. A growing economy like India, we need a small amount of fiscal deficit. That is always good for the economy. But the idea to bring it down to 4.5% is very important because the rating agencies, the sovereign rating agencies will have a view on this thing. So the procedure or the method to bring down this fiscal deficit to 4.5% is a good thing because our ratings can increase if they see that, okay, there is a proper roadmap to bring down the fiscal deficit. So sovereign rating agents, maybe 1 year, 2 years back, I think there was a little bit of pressure in the economy when the sovereign rating agencies had downgraded or brought it to neutral. So this fiscal deficit or fiscal discipline can have a positive impact on the sovereign rating agencies as long as we follow the roadmap. And also in the budget, the focus on the ease of doing business or, ease of complying with regulations. That is also, they are maintaining a little bit of uniformity in terms of that. So that all that means that from an investor that is outside, especially a foreign investor, it could be an FII, FPI, even for FDI also. When they look at it, they see uniformity, they see continuity, they see ease of doing business, and that can bring in more inflows, more foreign money into the stock markets, and that can have a positive impact on the market. So from that angle, when you look at the macroeconomic measures that have been proposed in this budget, or even the lack of big budget, let's say, changes or amendments in the budget, which means that the ease of doing, I'm not saying that we are completely there, but yes, it is a start. This whole budget, I think it is a roadmap to go on to bigger things, and it is a small step, but yes, it is in the right direction, and I think foreign investors will have a positive outlook on that. Of course, many of the measures, personally, I would say that, it is directed towards India already being a developed economy. Maybe as an economy, we might not be ready for some measures, but it is assuming that India is going to be a developed economy soon, and we are already starting the steps to achieve that. So, as I mentioned, the macroeconomic measures, it has the potential to bring in more foreign investor participation into the stock market. So, as a whole, that is positive for the markets. Again, the measures to improve rural economy, very good measures in the sense that, as we talked about earlier, it was a K-shaped recovery earlier. Rural economy was not doing well. So boost to rural economy, rural spending can improve. The focus on employment, of course, means more disposable income in the hands of many youngsters. Upskilling is also a good thing because it increases the employability of many of India's youth. Agricultural growth and productivity also. So all these measures together, I'm not going to the details because we've already seen what the measures are, but all these measures together, what it simply does is it can, or it has the possibility to improve rural spending. And that is something that has been missing maybe for the last couple of years. That has been not missing in the sense it has been not up to the levels expected. So this is basically very positive for the FMCG industry. I would say the industries that are consumer facing or industries that do not have big ticket items. So FMCG, especially these measures will be good for the FMCG sector and also the allied segments. Okay, even two-wheelers can also benefit from this because that is one sector that can benefit from more rural disposable income. So the measures that the government has come out for boosting rural economy, boosting rural spending, I think it will have a positive impact on many of the allied sectors, especially dealing in the low ticket items, including FMCG, it could be two-wheelers, it could be even these small white goods companies. So companies that have more small white goods to sell, it will have a positive impact on these sectors and stocks. I will not be mentioning specific stocks because there is regulation that I'll have to follow, but offline we can always discuss that. The capex spends, yes, it was a good amount. I think it was in the range of 11.1 lakh crore that was proposed by the finance minister. The thing is that as an amount it is good, but there was no change from the interim budget. So the interim budget amount, the capex spend that was mentioned in the interim budget and what was mentioned in our budget yesterday, there is no change. So even though the amount as such is a good number, even in the third point I've mentioned that the ratio of capex to total expenditure has actually improved to 23%. It was 21% last year. So the ratio of capex also has improved. And a professor was saying that it is always a good thing that the ratio of capex to the total expenditure improving is a good thing because the quality of spending is actually improving. In terms of the stock market, though, the problem is that, when the interim budget capex was announced, the market started pricing in that capex spend into the stock prices. So, especially with regards to companies, the investment-linked companies, it could be the capital goods companies. What happened was that the stock market already started pricing in the capex spends into the stocks. Into the railway stocks also. Railway stocks, again, a lot of them started going up because they started pricing in the capex spends. But since there is no change from the interim budget to the actual budget, we feel that a lot of growth has already been priced into these stocks. So it is not that capex spend is bad or it is not up to the level, but there is a feeling that a lot of it has already been priced into these stocks or the stocks that are expected to gain from capex spend. So the valuation is already factored in the interim budget numbers, and since it has maintained status quo, there could be a slight underperformance in these sectors, in these specific stocks, including railway stocks also. Right? So that is something that we need to keep in mind. It has nothing to do with the quality, it is to do with the valuations, basically. Again, there was, I think, a bit of pressure on the government, the budgetary allocations based on the coalition party requirements. So you could see a focus on two states mainly when the finance minister was talking about infrastructure, Andhra Pradesh and Bihar. You could see the focus of the infra spend. So again, if you want to play that, you can look at the companies that are mainly operating out of, let's say, Andhra Pradesh. You can look at the companies mainly operating out of Bihar, because you can see a lot of infra spends in Bihar. You can see, as per the budget proposal, if I'm not mistaken, you could see a lot of highway allocations, a lot of highways being built. So road developers that are active in Bihar, for example, or, you could see the historical order generation over there with regards to highway developers. You can see, you can maybe play out that story over there. Even in Andhra Pradesh also, there is a lot of focus on building roads and building infra assets. So you can, if that is the case, maybe you can look at those companies that are active in Andhra Pradesh and Bihar when it comes to infrastructure. And of course, the capex, the spends were also in urban housing. Urban housing is also another focus area that the budget was mentioning. So we have a lot of stocks that are very active in the low-cost housing segment. So you can look at those stocks, because this is another segment that has been given good representation in this. And of course, power, energy security, building small Bharat reactors, power would also be another area that the budget has focused on. But overall, when you look at the capex situation, it is definitely positive for cements, because irrespective of where the infra is happening or where the roads are being built, cement always plays a huge part in the infrastructure development. So a lot of cement companies, especially the big cement companies, they are this budget measure will have a positive impact on these on the cement sector. Of course, I was talking about the highway developers and also power companies. So overall infrastructure spend. So infra spend is again, it's nothing new. It is not going to be anything new in the coming years also, because that will be a focus for the government, the infrastructure development. So it is always good for us to keep track of infra companies, maybe identify a few companies that can benefit from any special focus that the government brings in. So that is with regards to the capex spends that the finance minister has proposed in the budget. Of course, the direct tax, I think Ms. Priya has touched upon the LTCG changes and the STCG taxations. It was a bit of a negative surprise for the market, in the sense that it was not completely expected. Although we didn't mind a small increase in LTCG taxes, we also expected that maybe the STT, that is a securities transaction tax, might be done away with if the LTCG was increased. But of course, LTCG and STCG was increased. It might not have too much of an impact, a long-term impact on the stock markets, because if you remember, we did not have LTCG. LTCG tax was zero at one point of time, and then it was changed to 10%, in the sense exemption limit is there. So if your long-term capital gains was, below 1 lakh, there was no tax. Above 1 lakh, whatever is the amount would have been taxed at 10%. So that was also changed recently. Now it is again being tweaked, in the sense that up to 1,25,000 would be exempt, and any amount above that would be taxed at 12.5%. So the change, of course, in the short term, yes, it could have a negative bearing on the stock markets. STCG to 15 to 20% would have a short-term impact, but overall, I don't think this is a game changer, especially with terms of LTCG. And two schools of thought always, in the sense, okay, why are other, let's say, financial assets being taxed at, let's say, 30% income, while only stocks or listed securities are being taxed at this low rate? Maybe considering the last couple of years, the performance of the stock market, the kind of returns that is generated, I think the government would have felt that yes, it is time to start, bringing up to the developed economy level. So that would have been the thinking on that. But that is something that we'll need to keep expecting in the future also, because even the finance minister's commentary after the budget also alluded to this fact that, this is not the last time they will be looking at the LTCG. So we can keep expecting a few tweaks here and there with regards to the capital gains taxation. Property sale also, the 20% with indexation has been brought down to a uniform 12.5% long taxation. Now, that is, in a way, when you look at it, it is negative for realty companies, for these real estate developers, if you look at it, because the indexation benefit was always a good thing. But we need to keep in mind, we've not worked out the entire math behind this, the long-term capital gains being brought down to 12.5%. But the basic understanding is that if you've purchased a property recently, in the sense it is not too old, it is not an inheritance, or it has not been carried over from a generation or whatever. If it is recent, then this might be beneficial to you, because 20% has been brought down to 12.5%. It could be a negative impact only if the number of years that you've held the asset is too long. Then yes, it could be a negative, this change. If it is recent, then it might not have too much or in fact it might be beneficial for you as an investor or as a seller. So that is something that you'll have to look at on a case-to-case basis. But overall, yes, it is a bit negative for the real estate developers. The reduction in customs duty, a lot of sectors the customs duty has been reduced for example, gold. Gold was a surprising thing because, the customs duty on gold has been reduced by 5 to 6%, if I'm not mistaken, which has actually started reflecting in the gold prices yesterday and today. If you look at it, it has started reducing. So that is actually positive for jewelers, right? The reduction in the customs duty, it is good, positive for the jewelers. And that is why you saw stocks like Titan and all that going up yesterday, because for them it is beneficial. But maybe from a gold financing company, from that point of view, it could be a bit negative because, again, the loan to value ratio would be impacted because of this. So the reduction in customs duty, it is good for jewelers, but it could have a negative impact on companies like gold financing companies. The customs duty reduction, it would be positive impact for battery manufacturers, textiles, aquaculture also. For example, shrimp feed, for example, the customs duty and all that has come down. So overall, when you look at it, the customs duty thing, yes, it has been marginally positive for many sectors, and that is something that you can look at. The one thing is that, surprising is that, of course, I was mentioning about the reduction in customs duty for gold. So there is a talk of how the government is now slowly shifting. Earlier it was focusing on the financial assets, about investing into the stock market, growing your financial assets. But there could be a subtle shift away from these financial assets into physical assets like gold also. So in terms of, the government coming out with, let's say, this reduction in customs duty for gold, there could be a subtle shift in the sense that it is not just financial assets that are important, it should be physical assets also that need to be important. So that could be a subtle shift. Of course, the STT we saw on F&O, the Securities Transaction Tax on futures and options, has been increased. Personally, we at Geojit, we've always felt that F&O in the current situation, it is becoming a very dangerous tool, especially in the hands of inexperienced investors. So any measure to, let's say, I wouldn't say to authorize or rationalize, but to have it in the right hands or in the right investors' hands, I think it's a good thing. And this is not the last that we are seeing with regards to F&O, because SEBI has made it extremely clear that they will be bringing out more measures. The government has also made it clear. So this is not the last that we are seeing anything with regards to F&O trading. We can expect more measures to come in, and in a way it is good because we feel that, especially in this day and age, when there are financial influencers, rampant on YouTube saying on how easy it is to make profits by doing this and doing that, especially in the F&O stage. It is actually misleading a lot of investors into how easy it is to trade in F&O. So we can expect more measures on F&O, and provided F&O should not be curtailed because it is also important. But I think investors should be more aware or authorized to do F&O trade. So that is something again that we are expecting. Of course, the income received on buyback is also to be taxed in the hands of the investor. So overall, when you look at it, again, these measures, I wouldn't say it would have a long-term impact. Of course, these are all sentimental or a kind of a short-term impact that will have on the stock markets. So these are the main measures that were there in the budget with regards to stock market. So when we talk about the sectors as a whole, we've talked about the infrastructure, the cement sectors, the FMCG sectors, and also sectors that are directly facing the consumer, especially in the rural economic setting. These sectors are also supposed to do well. So going forward, again, as I was mentioning, the budget, it will have a limited impact on the stock market. The budget has been good in the sense that, it was focusing on fiscal consolidation, The estimates that the government has come out with, these are all realistic. There are no much unrealistic estimates. The capex thrust is always good. A continuity on that is always good. The domestic consumption focus that the budget has brought out, it is good. So when you look at it, there has not been any negative impact or negative things regarding the capital market. The only thing that can impact the market is definitely the high valuations. So high valuations, of course, if it is being met by an equal measure from the government with regards to increasing the earnings or increasing the orders of particular companies, of course, these high valuations can be carried on. But at the moment, yes, the stock market, the valuations are a bit of a concern. We were expecting a little bit of correction. Even yesterday also it surprised in the sense during the budget speech, I think it went down, and then by the end of the day, the markets had recovered. Today, of course, there was a slight negativity, but we've not seen a meaningful correction in the market for some time. So any earnings downgrade, so the earnings season is going on, any earnings downgrade can have an impact on the market performance also. So going forward, our suggestion would be, of course, the market cap allocation would also be important, because large cap oriented, it should be large cap oriented, because mid and small cap, of course, there is only a little bit of room, let's say, for valuation. It would be safer to be in the large cap segment, and of course, accumulation would also be a very good idea right now. Instead of investing everything in one go, accumulation would be a good idea. Momentum stocks had that time, of course, because the market was doing well. Momentum stocks were all the rage. It was a good rage, but right now I think it would be good to focus on quality rather than momentum. And as per our fundamental research team, the base case target for Nifty is, of course, in December 2024 is 24,600, which does not give much room for leeway. But then, of course, in the short term, there could be a bit of underperformance. But at the end of the year, we see the Nifty base case scenario at 24,600. Of course, the plus would be 26, the minus would be 22, but base case scenario is 24,600. And this is purely driven by, of course, the GDP expectations, the FY25 GDP expectations, on the hope that there would be more foreign investor participation also in the markets, which could help bolster the markets. Right. So with that, I come to the end of my presentation. Any questions? I think we can take it up later. So thank you very much, guys. Thank you for the opportunity. Yes.